Happy New Year, everyone, and welcome to the first weekly update of 2026. A lot has happened in the last few weeks since I've been gone. The first big headline you've all been hearing about is mortgage rates went down to 5.99%. It's our first time below 6% in a very long time. But the bigger news is, why did it happen and will it continue? The second headline you've been hearing about is the ban on Wall Street investors buying rental properties. And the third is that GSEs were instructed to buy $200 billion of mortgage-backed securities. We're going to talk about all of these things here in a minute. Nationally, housing inventory growth has slowed drastically. If you'll remember, we got as high as 33% more homes for sale year over year, sometime in the middle of last year. Well, starting out this year, we're down to just 9.99% year over year growth in inventory. The number of people applying for mortgages remains at a multi-year high, thanks to these low rates. And locally, both Dallas and Collin County had a ton of new listings this week. So we're covering all this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button, and if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is January 12th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here to get to the latest weekly market update. Okay, starting with market news, the first big headline is mortgage rates went down to 5.99%. In order to truly understand everything I'm about to say, you need to understand how mortgage rates work and who actually sets them, and most importantly, you need to understand the mortgage spreads. And I finally made a standalone video covering all of that you can watch here if you want to learn more about it. Otherwise, the long story short is Trump announced that GSEs were directed to buy $200 billion worth of mortgage-backed securities. The idea is buying all of these mortgage-backed securities increases demand for those bonds, which makes yields fall, which makes mortgage spreads improve, so mortgage rates come down. This is why you saw mortgage rates drop about 0.2% when he announced it, even without the 10-year or the federal funds rate moving at all. What happens is when he announced it, lenders rushed to improve their rate sheets, which is essentially investors are front-running what they believe the result is going to be of this action, of this spending. So right out the gate, the market said it's expecting $200 billion of spend on mortgage-backed securities is going to improve the spreads about 0.2%. So what you need to know is that 0.2% drop is just the market's best guess. Also, it's temporary, and you can see that the spreads already went back up a little bit. So once this $200 billion spending actually occurs, it's likely the spreads will get a little bit worse as the reality of what the result is going to end up at comes to light. So in my opinion, we'll probably give back somewhere around half of that gain, and we'll end up with a maybe 0.1% to 0.15% better spreads than we had before the announcement, which means mortgage rates will probably drop by 0.1 to 0.15% as a result of this, which is not huge, but it is better than nothing. But also, mortgage spreads have already been improving naturally for the last several years. They've been trending down back towards normal, and normal spreads would be somewhere in the 1.6 to 1.8% range. And after this announcement, we got as low as about 1.9%. So we're already getting pretty close to normal. So even if we do give back some of this gain and we go maybe to 1.95% spreads, throughout the rest of the year, we should continue slowly trending down towards that 1.6 to 1.8 range anyway. So this may have accelerated that timeline a little bit, but we were already going to get there probably later this year. So the very long story short, $200 billion to spend might improve mortgage rates by 0.1%. in the short term. The next big headline is the ban on Wall Street investors buying rental properties. How big of a deal is this? Is it a good idea? Is it even possible? And will it make housing more affordable? Okay, first of all, if you will look at this chart, you will see we are now at about 65% of homes being owner occupied. This is the home ownership rate. And the thing is, this is not single family homes. This is just the unit that someone lives in. Do they own it? Yes or no? And you can see over time, we did have a big swing up and down here, but if you look right through the middle, we're slightly above 65, which I would say is a pretty good median. So like we're about where we should normally be. 65% of people should be owning the units they live in, and that's where we're at. So the remaining 35% of units are rentals. But this chart also includes apartments and units that people otherwise cannot own. They're not for sale. But the point is, overall, time has proven that 35% of homes on the market is a healthy amount for all of those people who either don't want to own or they can't afford to buy a home. That makes for a good, strong rental market, 35% of homes. But then once you zoom in on just single family homes, investors do purchase about 25% of homes sold, which sounds like a lot, but you have to remember, investors are also actively selling as they're buying as well. So in the end, if you look at this chart, only about 9.9% of existing homes are actually owned currently by investors. So you have the buying and selling side where they're buying 25%, but they're also selling a lot. And so the actual stock that they hold of the entire inventory of the country only comes out to less than 10%, about 9.9. But the chart that's really going to surprise you is that institutional investors, this means companies that own or transact more than 100 homes, they're only buying about 1.5% of all homes. These are the people that legislation would affect if it were to happen, 1.5% of the transactions, which is almost nothing. So that's the data, and the reality is this ban wouldn't force them to sell any of their inventory. It would only prevent them from buying in the future. It only applies to institutional investors, so it wouldn't affect the buy 1 to 10 houses in an LLC guys, who actually make up a majority of the investor transactions. It would also probably take legislation to actually accomplish something like this. And again, at the end of the day, it would only stop the guys who are already only buying 1.5% of the homes on the market. It would just keep that 1.5% from buying any more. But since 1.5 is basically nothing, for me, this does not do anything to help the housing market, if it ever even amounts to anything. So I think it's an exciting headline. I think most people don't understand just how little institutional investors actually own of the market, but it's really not even anything worth discussing. Whether they buy their 1.5% next year or not is not going to change housing prices. The only way to lower housing prices is by building a lot more houses. I did not film any property showcases for this week, but I think next week I should have at least one new listing to show you guys. I've also been doing neighborhood tours lately though, so if you haven't seen those, you should check this one out. I think that's the latest one. This one is the Reservation neighborhood of Richardson, Texas. It's one of my favorite neighborhoods in all of DFW. I highly recommend it to anyone. If you want a beautiful home like these, you could get one, a starter home, anywhere from $600 to $650, and you could build something all the way up north of $3 million here. And there are some truly incredible houses. It's a great location, very central to the whole metroplex, only about 17 or 18 miles from downtown Dallas. So if you're looking to move somewhere like this, you're going to save easily $200,000 or $300,000 living here versus living in Dallas, and you're the very first city directly north of Dallas. You can still get to most things in Dallas in 15 to 20 minutes. All right, moving on, let's start with national housing inventory. This week we had a huge decrease, although everything I'm about to say, all of the data at the beginning of the year, this is why I don't even make a video the first week of the year and the last couple weeks of the year, because the data gets so skewed around the holidays. But you can see there's always a dip right here at the beginning. So just take everything this week and probably next week with a grain of salt. But this week we had a huge decrease of 33,318 less homes for sale in the country. Like I said, it's normal for there to be a dip right at the beginning. That's what we're seeing. This happens because buyers are now returning back to the market after the holidays, and they eat up the little supply that was there. We're gonna get some more new listings coming up, and then we're gonna go like this. But this drops us all the way down to just 9.99% more inventory than we had last year. Like I said in the intro, last year in the middle, we got as high as having 33% more inventory somewhere around here. We had a huge spread of 33%. Now we're down to about 10%. But we have 686,784 homes available for sale in the country. The same week last year, we only had 624,419. So even though it's just 10%, we're still better off. Every single year we're trending back to normal inventory, and that's great news. Then for reference, the all-time inventory bottom here of 2022, we had 240,000 homes for sale. In the peak of last year, we had 867,000 homes for sale, and right now we're at about 687,000. Now looking at new listings, you can see how big of swings we have here at the beginning of the year. We had a huge jump this week. As we start to get back to a normal inventory, we can almost start trusting this number probably next week. But this week we had 17,849 more new listings than last week in this big jump. As you're going to see, we saw it also here in Dallas and Collin County. It's just due to seasonality. You can see it happens every year. And it's still actually 5,632 less homes than we had last year listing this week. But we had a total of 39,007 new listings in the country this week. Now let's see, now on to pending sales. Now on to pending sales. This week, pending contracts decreased, that's over here, by 9,926. Again, the data is always weird at the beginning. You're gonna see it's gonna start jumping up like this probably next week, which still gives us 4,251 more homes contracting this week than we had a year ago. So you can see new contracts are still growing every single year, for a total of 256,837 homes currently under contract. The last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. And looking at the national chart, we decreased, I don't know if you can see that yellow line very clearly because it's so small right now, but we had a decrease of 1.4% week to week, so that means 1.4% less homes took a price cut this week. You can see a decline is normal for the start of the year. So that gave us 34.72% of homes took a price cut this week. But last year we got as high as 42.1%. The year before we got as high as 39.9%, and then back in 2022 when rates were going up to 8%, we got as high as 43.2%. But you can see the last 2 years, 24 and 25, the trajectory was very close. So I'm interested to see if we follow a similar trajectory this year. But just so you know, if you want home prices to be coming down, this number will need to be going up. Okay, moving on to mortgage rates. You'll remember you saw the headline that they went down to 5.99%. Here at Mortgage News Daily, they're reported at 6.06, but today they're reported at 6.01. Which any way you look at it, we have a full 1.23% lower mortgage rates than we did on this day last year, and that is a huge improvement. I mean, just look how long this has been trending down and down and down. Now, I don't think we're gonna keep trending down right now. I think we're gonna hold around 6% for really probably around 6 to 6.3. I think it's likely we're gonna go around there. Truly, I don't think we're gonna see lower than probably a 5.75 for a 30-year fix this year. But even that makes a big difference on your monthly payment. I also don't think we're gonna see any home price growth this year, for what that's worth. Then looking at mortgage purchase applications, this year we only have the one dot so far, and it's currently showing a 10% year over year gain. But again, this data of all of it is the most skewed right at the beginning of the year, so I wouldn't even really pay attention to that. It's just factually it says plus 10%. We're gonna have to wait a few weeks to see where mortgage demand really is. But it has been my belief for years that real mortgage demand is gonna come in once we get at and stay at or below 6% rates for a sustained period of time. And so far we've had about 1 day there. So if we can at least stay at 6 or even get a little below, then I think we're really gonna see some increase in mortgage purchase applications. But this is really a leading indicator. If you start to see growth here, you can expect to see it in the sales data 30 to 90 days later, as that's how long it takes to contract and close and find the house and all that. All right, now we're moving on to the local markets, starting with the MLS data of Dallas County. I didn't do last week because it wasn't a first full week, so this is our first full week in January. It's now the 12th. But this week we had a huge 665 new listings in Dallas County, and that's about where we were last summer. So like in the highest weeks of our listings, it's gonna be around a 665. So that's a huge way to start the year. Again, it's definitely skewed because of the holidays. So we're gonna have to wait probably a week or two to see where our new listings actually gonna be around. Then closings, we had 216 closings, which is more than I expected. Of the homes closed, 31 were immediate sales, meaning they contracted within the first week. We had 205 new contracts this week, and in total, we're starting out with 1,511 homes either under contract or pending. And very quickly, looking at Collin County, we had 490 new listings, which again is on the higher end of new listings for Collin County. We had 128 closings, 16 were immediate sales, 127 new contracts this week, and in total, 1,397 homes are under contract or pending in Collin County. So this data is going to mean a lot more once we can start tracking weekly and seeing how much it moved. But this is our baseline for the year. All right, now we're moving on to the market action index, starting with Dallas County. If you've never seen it, it takes into account all this data, puts it into one easy to read graphic with a number. Anything at 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in? And we really just use this to see, are things looking normal, or is anything looking unusual we could be concerned about? So the first thing that I notice is the market action index has actually been climbing since December 5th. And it has not stopped climbing, so the market has been heating up. That's not too surprising because we could see in the purchase application index at the end of last year, we could see more and more people applying for mortgages. So I could see why it looks like we're heating up a little early. But again, even though this looks like a big run up, it's just 33.8 to 34.7. So it looks real exaggerated on this line, but it's actually very small moves in the market action index. But Dallas is at a 35 slight seller's advantage. Things that are unusual is the median list price has started to climb just this week, a few days ago. So that's our first move up. That doesn't mean it needs to come all the way back up, but it does look like it has stopped its descent, which usually the bottom for prices happens, at least historically outside of the COVID years, it was around end of January, early February, and then during COVID it got into like March, April before we saw a bottom of prices. So if we were to find a bottom in prices end of January, early February, that would be normal. If we found a bottom of prices at the very first week of January, that would be unusual, but it's too soon to tell, so we'll see. Also, median price of new listings, it's unusual that it bounced all the way back up to this old range it was in all of December. Again, this is just 1 week data. It could come right back down, so it's nothing yet, but it will be unusual if this ends up being the bottom of prices. Average days on market is going down. That's another signal that things are heating up, from 123 down to 119. Median remained at 84. Homes having price decreases, just as we saw nationally. It's normal for them to be coming down here at the beginning of the year, but you can see it is trending down here in Dallas County. Inventory is dropping, just like we saw nationally. And then, as I said, the market action index is already heating up, but this is not some huge move, but it definitely looks like the trend has changed from down to up. So that would be unusual. Now looking at Collin County, same thing. They bottomed out on since October 31st, they have actually been heating up in Collin County. And it hasn't yet reflected in the median list price, but it has in the median price of new listings. And they're a 33, so they are 2 cooler than Dallas, which was a 35. But their median price of new listings is about the highest, almost to the highest that it's been in the last several months. The overall median list price, though, as I said, is still flat, has not turned yet, but it does look like it has stopped its descent. Their average days on market had a drop this week as well, 121 down to 116, so that is unusual. Their median remains at 91. Price decreases are coming down just like nationally as normal. Inventory as well is dropping, and the market action index continues to climb. So it does look like the trend has shifted from down to up, potentially 3 to 4 weeks earlier than a normal market, but several months earlier than a COVID market, which we're almost out of. That's the good news. So we should be expecting things to be bottoming out sometime in January, February, instead of where it has been. So too soon to really tell anything. But for the last time, it's 1 week data. That's too soon to tell anything. Let's give it another couple weeks to see if a trend develops. Now we're moving on to the top 10 ranked hottest and coolest cities and zip codes. I'm not doing they moved up or down because I didn't track the last few weeks. So we're just setting a baseline this week, first week of the year. The absolute hottest city for the year starts out as Coppell, Texas at a 42.81. Remember, 30 or below would be a buyer's market. This is quite a bit hotter. Followed by Grapevine, Carrollton, Louisville, Grand Prairie, Lancaster, Plano, Richardson, Allen, and then Cedar Hill comes in at number 10. Looking at specific zip codes, the absolute hottest is Plano 75093, that's at a 43.35, then Coppell 75019, Dallas 75206, Grand Prairie 75052, Grapevine 76051, Dallas 75232, Dallas 75234, Louisville 75077, Carrollton 75006, Lancaster 75146. So if you have a home in one of these zip codes, you should be able to sell for top dollar. Then looking at the coolest cities and zip codes, the absolute coolest, which was most of last year, it was the coolest, is Whitewright, Texas. It's down to a 27.13, followed by Nevada, then Leonard, then Anna, Royce City, Rockwall, and then right at Salina, we leave the buyer's market territory. We get just above a 30, which at the end of last year, all these 10 were buyer's markets. And so now Salina and up are not buyer's markets. So we have Salina, Farmersville, Melissa, and then Balch Springs at a 30.59. That's the 10 coolest cities, and then the coolest zip codes. The absolute coolest is Whitewright 75491, Dallas 75219, Dallas 75212, Nevada 75173, Leonard 75452, Anna 75409, Dallas 75236, Royce City 75189, Rockwall 75087, and Dallas 75240. And at a zip code level, all of these are still buyer's markets. So that's it for this week. I look forward to tracking the whole real estate market with you this next year. As always, if you're looking to buy, sell, or invest, call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.